So good morning to all of you, and I'm very excited to have this office panel with you today. And as Sunil had mentioned in his presentation, that today wealth management encapsulates a lot of things. The title of this particular session is Wealth Management 3.0, the rising role of alternatives. So what is Wealth Management 3.0? A lot of you would be wondering. So according to me, the first phase of wealth management was when distributors, were giving whatever products the clients wanted. It was a simple world there, maybe 25, 30 years back, when I started my career. So gave the clients whatever they wanted, and that was, and it meant providing good service and being prompt, and that was about it, and helping a lot with the paperwork. So that was wealth management 1.0. We moved to the next phase. We started talking about financial planning, and the main product then became mutual funds. So that was the product around which that was the main product in the client's world. And as things evolved, India became richer, the investment market became more sophisticated, became more diverse, and we found that it's two very different worlds altogether. There's a lot of customization which is required, and there are many more opportunities. So this is what I call wealth management 3.0. So in this context, Amit, I'll start with you. How are client demands changing? How have you seen client demands changing over a period of time?
Morning, everyone. Prem, I would like to start with an analogy here. If you try to look at the US auto industry right from 1960s, Toyota first introduced a car called Corona in 1960s, and the Ford and the GMs then felt that okay, this is a college-going kid's car. Why should we be worried about it? From 1960 to 1970, from Corona they moved to Corolla, and these guys who had graduated from college had just started their jobs, and the first salary and later on easy finance available, people moved from Corona to Corolla. The auto industry still did not take their cognizance. As they move up and became CXOs, Toyota launched Camry, and people graduated to Camrys. After that, in order to tackle the uber rich class in the US, Toyota launched the brand called Lexus, and Lexus stands for luxury export to US. That's how Lexus got coined. So if you really try to look at it, now they were serving right from a college kid to a uber rich guy, and Ford and GM just lost the plot there. I think the MFDs and the bankers, if they don't graduate from Corona to Lexus today, which is from LIC agent, a fixed deposit to a AIF, PMS and alternates, I think we are going to lose market share. So the 3.0 is not only from the customer's angle, it's also from the manufacturing angle, wherein products have to be newer for the client, and I think it's more to do with people leapfrog in India. So if something is so common and so commoditized, I need something which is a personalized service, and that's where PMS AIF will probably hold their strength. So you have a better personalized service and a larger alpha to be generated. That's how PMS AIF is actually looked at.
Actually, I think it's a great analogy that Amit has shared with us. If you ask me, one of my colleagues has put it very well. He says that there is an impossible trinity that investors have to grapple with. The trinity comprises of three broad quadrants. There is risk, there is return, and there is liquidity. Now, for the longest time in India, people have been actually able to manage that trinity. People have been able to get good returns with manageable risk with very high levels of liquidity. But eventually, we all know that there is reversion to the mean. So at some stage, one will have to start looking at balancing these three requirements. To our mind, I think we are now at that juncture as the economy has grown, as markets have evolved, as valuations have become richer and as interest rates have stabilized, I think we've now reached a stage where investors have also become more aware, and they've also realized that over a period of time for them to sustain that kind of performance in their portfolios, they will have to now start looking at blending ideas which are beyond the ordinary. And that's really where alternate investments have come in. And I think over the last few years we've seen this evolution. Sunil shared some data with us. We think my firm authored a very interesting report in December of last year, which is called India Goes Alternatives. It's there on our website for those of you who are interested. We actually estimated the size of the alternatives market in India back in December of last year at $400 billion. Our expectation is that over the next 10 years, this will actually become $2 trillion. So we expect a 5x growth in this space over the course of the next 10 years. Needless to say, this growth will be powered by investors, by your clients. It will be fair that you stay at the forefront of this growth by making sure to upskill yourselves so that you're in a position to act as wealth managers and are in a position to offer a lot more solutions to your clients.
Thank you, Prem. I think for organizing this conference firstly. Very quickly on Wealth 3.0. I think the core principles of wealth, whether it's Wealth 1.0, 2.0, 3.0, they remain the same. Clients have to make good money for the risk they take. And alternatives is a very fancy English word sometimes, but I feel a lot of this people were already doing. So many people in this room have given money to their relatives to start a company. That's called private equity venture capital. So many people have given money to their friends on credit. That's called private credit. And a lot of me here have bought flats, commercial buildings, earned rent, and now financial assets are available. On exchanges, you can go buy REITs, you can buy InvITs. There's so much happening. So honestly, I think the business of wealth doesn't change. It is about protecting clients' money over generations. I think the nature of instruments have changed. And whenever any industry, the regulator is super evolved. We are very fortunate. I think SEBI as a regulator is extremely evolved. I think clients are evolving. When we service clients at Neo and we talk to the more affluent, more rich clients, I think their needs for alternatives, for such income diversified tools is actually going up. So regulators are evolving, clients are evolving, I think partners are evolving to have this room so full. And I think whenever any market, कोई भी market में जब ये trio काम करता है ना, regulator, distributor and client, everybody is getting evolved at the same time. I think that market truly explodes. And that is reflective of the numbers. I think what Sunil was sharing, I think in the next 2-3 years, 22 lakh crores will get added in PMS AIF, 22 lakh crores will get added in mutual funds. So there is a train which is already running. I think the train is already started. And honestly, it's very basic. It's just simple asset classes expressed in a different format to clients, which is why people call it alternatives in the first place. But actually, it's very simple. And something that maybe all of us have done at a more natural level in our lives as we have evolved, and clients are adopting it big time. In our portfolios, we can see clients taking 20 to 30% exposures to alternatives, and that number is actually going up dramatically.
Yeah, JP, I want to ask you a question. You run a business which has both mutual funds and alternatives. Okay. So how do you look at these two products, and which category of products is more important to you as a business?
So Prem, let me take you back to from where you started a journey. And I remember this is about 25 years or so, when you were yourself working with a manufacturer, and we would come to listen to you all and your team from Khatri Pioneer days. Those were the days maybe and markets evolving, we were trying to keep mutual funds that time. And in kind of thing, which all my three co-panelists have talked about. Now, we have already crossed $4 trillion of economy, with more millionaires and billionaires being made in India. And in the next 10 years, let's say 5 and 10 years, if we are touching $10 trillion in the next 10 years or so, we expect so much of wealth explosion that we may not have seen in the last 20-25 years, which we will see in the next decade. And I tell everyone that this is a space which will coexist for everyone, right? And many of your own investors are going to become yesterday investors who are like came to earn for themselves, build something. Even they are going to be the millionaires of tomorrow. Already it's becoming and the numbers exploding. So there's a space for everything from mutual fund, traditional mutual funds to PMSs and alternates we are talking about, and who knows, they may even evolve more in future. So if we learn anything from, let's say, the Western world, I will not be surprised that we may even, barring USA, we may do better in these numbers than anybody else. What I will tell the distribution fraternities, a lot of them are still in the no acceptance mode only because they have to evolve and they have to accept and upgrade themselves. So it shouldn't be that, they started the investors from the basic investment mode, build their wealth, and a lot of the wealth get migrated to these alternates because it is a need of the investor, it is a need of that portfolio. So everyone have to evolve, it is not, the market is evolving. So if they don't evolve, they will be left behind partly. So it is something which has to be, and coexistence is going to be there with the numbers that, if we talk about mutual funds at nearing $1 trillion, and as Apurva said, $2 trillion and so on. So these numbers will exist. So mutual fund will be $2 trillion, alternate will be $1 trillion. So everyone coexistence and upgradation has to be done with everyone.
Aja, you are a chief executive of a business. You're a manufacturer. Mutual funds भी है, alternates भी है. Simple सवाल है. If your time was 100, how much time do you devote to mutual funds and how much time do you devote to AIFs? Or alternates?
Sure. So I'll just put a ballpark number out here. So we have separate teams naturally, which is by regulation and which is also by ownership, right? Which is by function also. So currently our AUMs are about 12% is with alternates and about balance 85% is in mutual fund. But with the SIFs being introduced and we have already got a license for that, my ballpark number will be that in the next 3 to 5 years, maybe with us it will be about 1/3 going towards 1/3 to alternates and 2/3 will be with traditional because we have a very large base in India which is already existing. You cannot just write it off. So maybe if I am wrong, it might be 75% in the coming time, but on a very high base. The denominator is going to increase.
Yeah.
So even if the percentage moves from 12 to 24,
yeah,
it's going to be a very large number.
Okay, there is going to be absolute growth but in comparative terms, maybe alternatives will grow a little faster then. So, Amit, for your high net worth clients, is alternates an appetizer or is it the main course today?
I would say that over time your retail and medium net worth clients tend to become high net worth and ultra high net worths. There is a neo-rich category which has come in because of startups and other things. These guys are more on exploratory nature, wherein these guys want some exotic products. And those guys demand alternates rather than the traditional products. The problem is that SIP Sahi Hai is a campaign which now the high net worths have started feeling is a retail based product campaign. And therefore I might not be comfortable doing that. I want something which is probably one notch higher. And that's where the demand from these guys are coming.
This is one notch higher in terms of, say, returns, or is it in terms of the entire experience?
No, I think...
Or is it because of ego ki we bought pedestrian ho gaya, plug-in ho gaya, mere liye nahi hai?
How will I put it? PMS AIFs are like gym memberships. After 1 year, whether you get 6 packs or not, you get experience that you have paid that 1 year membership. But in a PMS AIF, apart from the experience, you also get some alpha. So why people are moving here is in search of that alpha, that in a normal mutual fund, you mimic portfolios which are probably kissing the index. So you're not able to create alpha. Can this happen here? Second thing is, a lot of restrictions, for example, like I have Mr. Daga sitting here, and Credits, they have done a fantastic job. So if you look at the mutual fund industry and the credit fund, there are a lot of restrictions on what to buy and how much to buy. While these guys can probably create bespoke portfolios for you. So you can create a really niche bespoke portfolio for the client segment that you are looking at, and accordingly the demand for that. 1 crore rupees and 50 lakh rupees. We are sitting in Mumbai. 1 crore is not an amount which everybody actually thinks is a big amount today, because you will not get a house in Dharma also, I guess. So 1 crore is not big. PMS, AIFs, I think that threshold, people are demanding those rather than we actually adhering to supply those. So it's the demand from the market in search of that alpha. That's what I feel.
Okay. Apurva, so is it just the search for alpha, or are some people also looking at, because there are a lot of complex products across the entire spectrum. So, or are they looking for wealth preservation? What are they looking for through alternatives? What are their expectations?
So I agree with Amit's assessment that alpha is shrinking in conventional avenues, and which is why people have started gravitating to alternates. But why look at only equities? Look at what is happening in fixed income. So today, interest rates are significantly lower than what we've seen at any point in time in the past. Look back, I mean, these are near lifetime lows on interest rates, near lifetime highs on valuations, which clearly goes to show that for people who are even wanting to preserve capital, conventional avenues, fixed deposits, mutual funds, bonds, we're not necessarily serve the purpose, because in post-tax, post-inflation basis, we know for a fact that there's going to be erosion, which means that even within an area like fixed income, for instance, you will have to start looking at higher yield options. Now, it's not that we've not seen this movie before. We did see this. We saw this when credit risk funds were ruling the roost. But we all know how that story played out. Now, fundamentally, if you look back, there was something wrong, right? You're essentially giving money to a borrower for a particular purpose, which was time bound, but you're investing through an open-ended construct. Right? You're investing, so there was fundamentally an asset liability mismatch. Today, it's a private credit fund, which is inherently a closed-ended structure. You're essentially giving money for a particular end use. So the probability of that debt getting serviced and the return along with the capital coming back to the investor is significantly higher as compared to what we've seen in the past. So I think the applicability of alternates to different objectives, whether it is capital preservation, whether it is appreciation, whether it is diversification. Hemant made this great point about people having invested into real assets in the past. Now real assets could also be done through the alternate investment fund route. Today, look at the way REITs and InvITs have kind of now become, frontline items. I was looking at the oversubscription number for the last REIT public issue. It is significantly higher than what happened in the first REIT public issue, which happened about 6.5 years ago. So I think what's happened is that the acceptance has also increased, and people have now started looking at the applicability of alternatives for different objectives to be met in their portfolios.
Hemant, I'll just turn the question a little for you. What are the key challenges, according to you, in integrating alternatives? You've been a part of evolution. In your earlier role, I think you were more on wealth management, and now you're more on asset management. How do you see the key challenges in integrating alternatives in mainstream wealth management?
So couple of things. I think evolution takes time. So firstly, we should accept it. I think education levels still need to go higher. I think the first thing people think when they speak alternatives is complex products. Why do I need this? At least knock off that inertia. Whether you need it, don't need it, is a second choice. First, evaluate dispassionately. And I think the more people evaluate dispassionately, some of these myths will go away. So education is a process of debunking myths, and that's my request to everybody to begin with. I think the other thing that can truly change a lot of alternatives is, I think the way NAVs are reported, the way reporting happens. I think mutual fund is a great platform because everything is liquid, everything is real time, it's so transparent, right? Yes, alternatives do have their challenges because you can't mark an asset real time. But at least if SEBI can put a framework, some more framework on reporting and get everybody on the same page, I think then, industry can truly catapult to the next level. So reporting is an important one because clients should know what they are at the end of the day making. And I think education, I think this room, we need to get these myths off. Just embrace first. Listen, learn, and then choose. There is always a choice of not to do.
Okay. There are a lot of distributors and wealth managers here. What is your message to them, JP? How can they play a bigger role in promoting alternatives?
Sure, Prem. I'll go back to what I said earlier and add to that. Your investors are becoming more prosperous, their wealth is growing, so automatically there is a space for different kind of asset classes, and this is so the alternate automatically becomes a part of it. If one is not upgrading themselves, then ultimately they will have to face some competition somehow. Maybe just a few years back, we wouldn't have thought the explosion we have seen in the HNI and especially in family office spaces. And they are asking for personalized products, and they may be, and they are very okay, and they are reached to a level when they are talking about risk returns. I think still in India, and it may still take some time, that we underappreciate the risk factor. We are only talking about performance, and some of it is a drop down, right? When you go to websites and all, and many of those things. So what I think is this, that educate yourself before elevating, and allocation becomes a part of the portfolio as per the requirements of the investor. It is here to stay. You cannot wish away. So it is better that one migrates themselves. Otherwise, they will have to face competition.
Amit, mutual funds are plain vanilla products. Hemant said that there's real time, they're transparent. On the other hand, you not only do you have a very wide variety of products on the alternate side, they're also very often very complex. So how do you match them with client needs, and how do you keep the messaging simple in alternatives?
And I'm candid here, JP, pardon me for this, but mutual funds lost the race to PMS and AIFs in terms of asset collection, yes. You have seen a lot of private houses which have much more assets in PMS and AIFs put together compared to mutual funds. Mutual funds still remain to be more of a retail product. People sitting in the room, let me tell you, the direct plan contributes 47% in a mutual fund asset AUM right now. Okay, we still are participating there. Alternate investments, they graduated much faster, and they were talking to the top 1% of this country's investor elite. How can we get there? We devised a plan that we will launch a SIF, that all the distribution partners, they can do a 10 lakh rupee AIF and they can get there. Yes, these are exotic products at times, but not all products are exotic. There might be some products which are exotic. Like the credit AIFs, if you really come to think of it, there are some exotic, there are some products which you don't want to touch in credit AIF. But there are some products in credit AIFs which are pretty okay. So you need to research them, you need to probably analyze them. What has happened, Prem, is that if mutual funds are like Google Maps, if you follow the blue line, then you will reach your destination safely. PMS and AIFs are shortcuts which are suggested by your cousins. Sometimes you will find a hidden gem, and sometimes you will enter a ditch. But with distribution partners, you have to choose the right cousin. I think if you can choose the right cousin, you can reach there.
So the distributor can be the right cousin?
Absolutely right. Because the product itself, if it is complex, from a normal pushing of product, it is the trust which the distributor is translating through the product to the customer in explaining the nuances. And that is more critical.
Okay. So Apurva, I wanted to ask you one. Would you agree with Amit that a lot of, as far as the 1% of the wealthiest in the country are concerned, they have more of alternatives today in the mutual fund than mutual funds in the portfolio? Is that correct?
I think they're complementary. I genuinely think they're complementary because there are certain aspects which mutual funds can address in terms of the liquidity part of their portfolio, which obviously you cannot see that getting addressed through alternatives. There is a certain amount of, let's say, participation which a mutual fund can address, which perhaps you may not be able to see getting addressed through an alternative, but it might turn out to be a little suboptimal. So I think there is space for both. The question is,
what is the breakup as far as, say, your book is concerned?
I must confess, we will have a reasonably large allocation to alternates because we cater to the ultra high net worth set of clients.
Bigger than mutual funds?
Yes, yes, it would be because to a large extent, a lot of the, let's say, the lower needs in Maslow's hierarchy are taken care of. Right?
Yeah.
You're not really kind of worried about the physical and safety needs. They've all been taken care of. You're essentially now looking at the higher pyramid, which will require you to kind of focus on self-actualization, creation of wealth, transfer of wealth, preservation of wealth. So all of that is where I think the applicability of alternates typically tends to be much, much higher. So you will see them both coexisting in our client portfolios, but yes, there would be a higher skew towards alternates in some shape and form. Now, whether they are in the form of PMSs, alternate funds, direct investments, that obviously is more a function of client to client.
And how have you evolved your communication so that your clients understand what they are getting into, and how do you match the client's needs with the opportunities offered by these alternatives?
Great question, because see, what happens is that every client, despite the fact that they may be part of the same segment, their needs are different. So there's a lot of engagement which happens with the client to try and, A, of course, identify the need. B, to then try and kind of understand how that need can be fulfilled or it can be met. And in most instances, you realize that the client is actually coming to us more like a specialist and not like a general practitioner. Because the needs that they wanted to address through the GP route have already been taken care of. Because they're coming to us as a specialist, then you have to kind of look at differentiated solutions. So conventional ones will probably not serve the purpose beyond, of course, like I said, addressing some part of the, let's say, the safety or liquidity requirements and maybe the market participation requirements. In which case you then have to start looking at solutions which are out of the conventional realm. And that's where alternates typically tend to be the first port.
Hemant, you have a variety of products, alternatives. How do you keep your distribution partners informed, educated? How do you make them understand the intricacies of their product so that your products are presented to the clients correctly?
I think different products firstly are suited for different clients. In alternatives, if I have to put a decision framework, so we do private equity, very simple. Instead of listed stocks, you are funding unlisted stocks. We do infrastructure. Basically, we buy operating roads, operating solar plants, and we give credit to companies, private credit. I think each product is for a different client set. Firstly, if I was advising a client, the most important thing is how much liquidity do you want in your portfolio? If you want it to be liquid, keep that part aside, then think about alternatives. Okay. The second question I would ask is how much regular income would you want? And then how much risk do you want? So if you want regular income, go for strategies like infrastructure, go for strategies like InvITs, which are listed on the exchange, liquid and regular income, and these are phenomenal instruments. If you want regular income, go for credit products, can get maybe 1% monthly coupon, 4% quarterly coupons. So figure out what you want. You want regular income, and if you want growth strategies, growth is a function of equity markets, right? So you can get it through listed stock exchanges, you can get it through mutual funds. But if you want to invest in innovative companies, companies which are growing in a very different India, and believe me, I think the nature of India is changing. So I'm not necessarily saying that, public markets, these very generalistic statements are sometimes very dangerous. But I think a lot of innovation is happening in private companies. And if you want to be part of those companies, a lot of those companies might just remain private for a long period of time. Before they hit public markets, a lot of the juice might be eked out. So, so you'll have to think through a framework, liquidity, risk, income kitna chahiye, and that is what we want to communicate to our partners. Finally, what do you want out of this?
JP, you have a fairly complex product in your product basket, which is the Khatri long shot. How do you make your distribution partners understand the intricacies, understand what are the underlying risks and opportunities in such an approach.
Sure. So Prem, our product is more than 7 years old now. So a lot of the part, that question that you're putting, we have already done that because, as markets were evolving, the alternates were evolving, we were part of that growth. So, complete transparency, simple communication, all of that is there. And most of our business is through the distribution channels only. Like they are through the wealth management, they are through the bank wealth management and so on. And little bit maybe I think it's also from the family offices. So, and as I said, it's a long shot one. The only challenge which, I don't want to call it challenge, but only sometimes the challenge that we face is, if we are sometimes sitting with the family offices, a lot of them actually may not understand but want the product. So there the distribution partners become very important for the suitability, because otherwise we may have a vested interest of managing it, and we may not have any benefit in terms of revenue at all in that. So, but I think currently this segment that we are catering to is already well aware to some extent, but for some percentage of it, which is very small for them to upgrade. Otherwise, and the only thing is the newer wealth managements, the newer family offices that we are seeing coming up. And maybe मैं थोड़ा हिंदी में बताता हूँ आपको. I met a person who has earned lot of wealth with thousands of crores. He's our investor. In the end, on a very joking note, I told him, sir, आपने पैसा कमा तो लिया, लेकिन आपको पैसा मैनेज करना के लिए अब कोई चाहिए जिसको ये नॉलेज हो, क्योंकि आपने इंडस्ट्री खड़ी की थी, आपने वो बेच दी, राइट. लेकिन ये पैसा मैनेज करना है तो आपको आपको वेल्थ मैनेजर वही चाहिए जो कि आपको उस जर्नी पे ले सके. So what was your nation earning, this will not be the nation managing your money. So those challenges will remain, but I think the industry is doing a good job out there.
Okay, now let's move on to global frontiers. Our investors, your wealthy clients, are they looking for opportunities overseas? Are they looking for global alternatives? And again, given the fact that the world outside is even more complex, different domains, different products, different tax, different regulatory aspects, how do you manage that?
So we have nibbled some outside, some clients who have their monies lying outside. We've tried to do something with it on the debt side. And for most of the clients, taking exposure outside is for diversification in currency. I think all this education loan and tourism and settling abroad and nationalities and citizenships, I think that's been oversold. It's more to do with that they want to diversify from the currency, and that's the prime example. So we've tried doing something on the debt side outside India. From India to outside through GIFT or through LRS, we have not tried doing anything, Prem. It's more of money which is lying outside of the clients that we have tried to. We have tried to showcase them what is available. You can't advise clients. Outside, definitely not.
Apurva, do you really see a big opportunities in global alternatives? And that's point number one. Point number two, is there really a demand for it from your HNI clients?
Is there a demand? Definitely there is a demand, because I think aspirations have evolved. Today in most families, either some of the other family member is already moving over, has already moved overseas, or is in the process of moving overseas, or intends to move overseas. So I think it's important to have a pool of assets in place so that when that movement actually happens, there is no reason for you to kind of run from pillar to post in terms of getting things organized. So there is already a demand. I think that goes without saying. I think people have also realized over a period of time that there is a very, very high level of home bias which exists in their portfolios, because at the end of the day, whether it is real assets or physical assets, whether it is real assets or financial assets rather, or whether it is in terms of equity, fixed income, you're denominating every single asset in the same currency. and the country is becoming very, very quickly integrated with the rest of the world, notwithstanding whatever is happening on tariffs. But the fact of the matter is that today we are much more integrated globally. So people are now inclined to look at building some level of overseas allocation in their portfolios. And you need not necessarily look at kind of reinventing the wheel. There could be opportunities which are complementary to what you see here in India. I mean, there are certain sectors or certain industries which probably don't have either a representation or a meaningful representation on the Indian bourses, or whether it is even through private markets. So there is a reason for people to look at opportunities in space like this. Of course, it also requires a lot of evolution, a lot of understanding. And I think once people get there, then the need for global diversification only increases.
Okay. Now I wanted to ask one final question, all of you, and I wanted you to look at the future of alternatives in wealth management 5 years from now. What percentage of client portfolios will alternatives be going ahead in future? And I'm obviously talking about HNI. What kind of product, how do you see the product landscape changing? And finally, how much of it will be domestic, how much will it be global?
I think in the ultra high net worth space, I would say that the needle will tilt towards alternates, because you can customize the product there. About 60% of assets should be in alternates in the next 5-10 years. It might be a pure long only fund, but it will be under a alternate. For example, a Prashant Jain fund is available only in an alternate space. So you will see more people doing that. So alternates will have more assets. Domestic, international, I really don't know which country to put your money on right now, Prem. So after 5 years, when we get there, probably I can answer that for you.
The number will go up, that's for sure. I mean, the same report which I was referring to earlier said that over the last 18 years, globally, the allocation to alternates has gone up from 10% to 15%. Today in India, that number is at about 7 or 8%. We think over the next 5 years, that number is likely to double. It can perhaps increase even further in the next 5 years, because we are kind of now realizing that generating the returns that we've experienced in the past with conventional assets is going to be very, very difficult. So the intention is, and I think what you will see is the fact that over the next 5-10 years, that number will probably become at least in the mid-teens, potentially going to about 20%. Whether it will be in India or overseas, I think it will still be in India. I still think that the bulk of the incremental flows in the alternate space will be in Indian assets, whether it is in private markets, as Hemant mentioned, whether it is in private credit, whether it is in real assets in some shape or form, or whether it is in a combination of all of this. That's something which only time will tell. But I think there is reason to believe that bulk of these assets will still be retained in India.
Hemant, the same question to you. I wanted you to add one dimension. What are the more exciting opportunities that you see on the horizon? You're a manufacturer. You're closer to the opportunities that way. So where do you see the excitement coming from?
Firstly, our view is in slightly more richer clients' portfolios, alternatives would be closer to 30 to 40%. And I'll give you a very interesting statistic. Go and look at some of the Canadian pension funds. They manage probably more money than any pension funds in the world. $700 billion, $500 billion, that's the size of LIC. Each of these funds are also managing same amounts of money. Their allocation to alternatives is 50%, 60%, 70%. Their returns in dollar terms, forget rupee, in dollar terms is close to 10 to 11% dollar compounded for 11 years. 10 to 11% dollar returns. अगर rupee depreciation add करेंगे तो 13 to 14% on $700 billion. So clearly tells you so much to learn, at least so much to investigate. Domestic versus offshore, I think currently it's clearly domestic. I think clients should focus on domestic. The industry is still evolving. क्यों बाहर देखें? वो complexity लाए क्यों? भी पहले इंडिया को ही समझ लें. इंडिया में इतनी अच्छी opportunity alternatives में. Or your third question, which is what exciting.
What is on the horizon?
I think these spaces are very large and deep. Credit is a big space. प्राइवेट इक्विटी इज अ बिग स्पेस. अब इन सब में ना थोड़े इनोवेटिव प्रोडक्ट्स आते रहेंगे, बट फाइनली मदरहुड थीम्स तो यही है. अब जैसे स्मॉल कैप है, स्मॉल कैप में एक स्कीम कुछ करेगा, दूसरा स्कीम कुछ करेगा, उसको मैं एक्साइटमेंट नहीं बोलता हूँ. स्मॉल कैप है, मिड कैप है, इसमें एक्साइटमेंट नहीं है. हाँ, तो प्राइवेट क्रेडिट इटसेल्फ इज अ बिग थीम एंड जस्ट प्ले दैट थीम विल बिकम वेरी बिग. द वर्ल्ड्स लार्जेस्ट फंड्स आर प्राइवेट क्रेडिट फंड्स. तो अभी हमको एक्साइटमेंट की जरूरत नहीं है, अभी तो हमको इसमें डीप जाना है. तो मेरे लिए तो अभी कुछ एक्साइटिंग नहीं है, जस्ट डीप जाते रहो. आई थिंक देयर इज लॉट्स टू डू इन दीस स्पेसेस.
JP, finally, I take the question to you. You did hint at the fact that going ahead in your business, the business mix could be 25-70, right? But are you looking at some other exciting opportunities, product opportunities on the alternate space?
Yes, Prem, we are looking at it. As a matter of fact, we are already finalizing a product which I think somewhere in the next quarter we'll launch. We are doing some basic check with our distribution partners. There's little regulatory part which we are closing down on our firm level. I think post that we'll do it because and that will be again in the kind of in the long short fund because we already have one, we leverage on that again. And within the mutual fund SIF license we're looking at launching. You call it a mutual fund or you call it a separate specialized category. Yeah, because we want to leverage on a distribution setup. But let me tell you, there's a big challenge in the distribution because the last numbers were not encouraging. We have been doing a lot of training. The certification 13, the common derivative exam that is there, it's very tough one. And there's some portion which is irrelevant out there. So in June there were 55 people who had uploaded within AMC. Now they are 400. Within the 50% are from the ND partners and 50% from IFA. Okay. So it's not going to be so easy as initial thoughts might have been, but apparently I think this space will also build up in the coming time. It's interesting space can't be written off. Maybe where we started 10 years back in alternates, SIFs are starting some space out there, but with a more awareness at least in some form, and maybe a little touchy, but little bit benefits coming from the taxation part because this is part of the mutual fund. So yes, we are building up, and maybe next year we are thinking about more on the, which Hemant talked about, more also on the debt side. If we can get some products out there also.
Okay, great. So with that we come towards the end of our discussion. Just wanted to summarize and make 3 simple points. Point number 1. The panel agrees that there are big opportunities in alternatives, and if alternatives are not already the main part of the client portfolios, they definitely soon will be. That's point number 1. Point number 2, we had mixed opinion on what are the opportunities which are available globally, but yes, there is a lot of client interest in looking at global opportunities. And third, yes, the product landscape will get more and more sophisticated, though the basic products, the basic underpinnings of the products might remain the same. So with that, thank you so much for being such a wonderful panelist. So, ladies and gentlemen, give a big round of applause to these panelists.